Capital gains and losses are frequently subject to different tax rules and rates than ordinary gains and losses. In Arkansas Best Corporation versus Commissioner, a corporation tried to save money by categorizing a loss as an ordinary rather than capital loss, but the government eventually got the best of the argument at the Supreme Court. Between 1968 and 1974, Arkansas Best Corporation, a diversified holding company, acquired a significant amount of stock in the National Bank of Commerce, or the bank for short. Prior to 1972, the bank appeared to be prosperous, and Arkansas Best's stock purchases were intended to help it grow. After 1972, the bank's financial health declined, and Arkansas Best's continued infusions of cash were intended to help keep the bank afloat. In 1975, Arkansas Best sold most of its shares. It then claimed a tax deduction for an ordinary loss of nearly $10 million. The Commissioner of the Internal Revenue Service denied the deduction, holding that the loss from the sale was a capital loss, not an ordinary loss. Arkansas Best challenged this decision in tax court. The tax court held that stock purchased for investment purposes is a capital asset, creating a capital gain or loss when sold, but that stock purchased and held for a business purpose without a substantial investment motive is an ordinary asset, creating an ordinary gain or loss when sold. The tax court categorized Arkansas Best's stock purchases through 1972 as investments, resulting in a capital loss when sold. However, Arkansas Best's purchases after 1972 were made for the business purpose of keeping the bank solvent, so the loss from the sale of this stock was an ordinary rather than capital loss. The Eighth Circuit Court of Appeals reversed, holding that all of the loss was capital loss. The Supreme Court granted cert.